Wall Street ignores Main Street, not the first time. Hello, 2008. But we are starting to see cracks in the market, meaning the data is starting to catch up. We got lots to talk about today, so sit back, let's go. Hello and welcome to Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget, click show more for additional information and links on today's video. Also, if you're looking for a different opinion out of Wall Street and Big TV, please do consider subscribing. If you are new here, I do several videos during the month. 1st and 15th, market updates. Then I do educational videos. Most recent was lump sum versus pension. Also, what you see here, I will generally apply to my clients' portfolios. So these are actionable ideas. Today's agenda, we're gonna mix it up with what keeps me up at night. That's first up. Second, we're gonna go to those charts, see what they're telling us, and they're speaking to us, I can assure you that. We're gonna talk about sector spotlight just a little bit today, and then game plan, actionable ideas going forward. Let's go to what keeps me up at night. All right, first up, we're going to talk about those market cycles. Very important to us. Those are new. We are not a buy and hold type group. We do look at the cycles to help us make decisions. So right now, we are in cycle 4, deep cycle 4, in fact. Growth slowing, we started that in 2018, fourth quarter. The most important thing is inflation decelerates, right? Deflation comes into play here, and that helps us make decisions on some of our investments. First up, CPI, okay? One of the worst readings, the worst reading in history, that is deflation, consumer price index, okay? ISM, manufacturing, when you look at that, below 50 is considered contracting. We're about 42. The leading indicator to this is ISM new orders. Just the facts, ma'am. When you look here, fell off the chart last month. That's a sign of things to come in the manufacturing sector. And you see auto sales, right? No one was hurt in that photo. It was photoshopped. Auto sales have fallen off the cliff here, okay? Worse than 2001 as well as the '08 crisis. That's an issue. Unemployment is obviously the big issue here. I've got two lines. The blue line is what you hear on TV. That's called the U4. U6 are the numbers that include those that have given up. So even before this crisis, and you can see that that is through the roof, big time. Again, I've mentioned this in previous videos. I look for continuous claims to see those trends, and this number continues to go up. In fact, not only is it an all-time high, it's more than 3.5 times what we saw in our last crisis. So this is significant, okay? It's tragic, really, is what it comes down to. Participation rate, again, we have not seen a number like this since the 70s going back. So the consumer represents 70% of GDP, okay? If they're not spending, we're gonna have some issues. So last video, I talked about GDP, and I had said that we're gonna go down about 30%. Well, guess what? Revisions have come out. We're looking at minus 34% on GDP, okay? One of the worst ever is about 10% in 47. You're looking at a 34% contraction of GDP. That is massive. It is shocking. It is a problem. Next up, let's go to the big charts. All right, taking a look at the big charts. Again, you have to understand we're not a buy and hold group. So when I look at this, we're going to talk about our signals, and they help us make decisions. Short-term, mid-term, long-term. That's how we break up our portfolios. First up, long-term view. When I take a look here, it obviously does not look good, right? We've broken this line here. You have big-time negative divergence. most importantly, you've had a momentum crossover. Long-term, monthly is negative, okay? Next up is weekly. Now, this one's going to be a little bit more interesting. So we have had now 3 weeks in a row. We try to break above the 61% retracement on Fibonacci. Not sure about that. Click up top. I'll have a video there. Failed again, and we're failing again this week. So this really tells me a lot about the midterm picture. You are seeing some momentum coming back up. That's not surprising in the kind of activity that we've had, but we are still negative on the midterm view. So don't forget, if you like this kind of information, hit that like button and please do subscribe. So short term, every chart I'm looking at right now is year to date. I've got everything you see here on the charts. I'm looking at price, volume, volatility. I've got my Fibonacci's. I've got everything here. So let me go through and talk about what we see here if you're new. Okay, first up, that's our death cross right there when your 50-day moving average goes over 200, okay? That's your high, that's your low. And that's how you figure out the Fibonacci retracement. So real important here. We now have had a double top where we failed at the 61% Fibonacci. Now I'm recording this about 9:35 Friday morning. We're now down about 1%. Not surprising after yesterday. So what else do we see here as I look at the charts? Relative strength peak. Now I put a 5-day on that because I want to see the action over 5 days. Clearly we have peaked and we're coming back down again. Now, are we oversold yet? Not yet. That would show an oversold situation, okay? Next up, let's go down here. What else is real important on this chart? Well, for me, when I'm looking at it, right here, okay? It happened, folks. We got the short-term negative crossover. That triggered some of my hedges yesterday. And I got that across the board. Smalls, mids, large, all over the place, okay? We saw that. So I look at a couple things. I'm looking for the crossover, and I'm also looking, you can see better here if Andrew zooms in, the negative histogram. That really is your confirmation. We got that yesterday, and that told me to up my hedges. Talked about this one for a while. The VIX, Volatility Index, above 30, uninvestable. We have stayed there, continue to stay above 30. Overall, when I look at things, we are definitely in a negative. I think a classic bear market move is a thrust down, a move up with a failure. We just had that. We are consolidating, and then the next move I anticipate to be down based on all of those fundamentals I just showed you. Now, a couple other things, okay? Haven't shown this before. So I've got the S&P, I've got mid cap and small cap. The S&P has been driven by what? We call them Robin Hoodies. Okay, these millennials, these young investors, low volume, they've been pushing this market up, okay? Especially the S&P's been driven by 5 names, right? The FANGs. But look at mids and smalls, okay? Mid caps down 26% from its high. Small caps 31%. It is not a party unless everyone's joining in. And right now, the only one that was sort of dancing was the S&P. I'll continue to watch that. Next up, PE, right? Price earnings. Is a market expensive? Yes, this market is ungodly expensive. Now, let me explain why. When you look at this, okay, as of today, not forecast, okay, there's your 20 PE, your 15. So if we hit a 15 PE, that would be 2100, 1400. The problem with this chart doesn't show projected. So let's look at projected. Wow. This is based on a 24% earnings decline in the second quarter. All these numbers move back. Fair value, 15, is 1400. Not saying it's going there, but right now it shows you how overpriced this market is. You need to be aware of that. Above 30 on the VIX is not a time to buy. Wrapping this up, I wanted to put this in here. You have to understand FOMO, fear of missing out, okay? That is clearly an American thing, right? That's driving it back up. Here's Germany, minus 25% from the high. The overall emerging markets, minus 20. France, 30. Spain, 35%. Last but not least, Australia, minus 26%. First recession in history. Let's go to the sector spotlight. All right, first up, sector spotlight. I am not going to go through this, just going to talk about it because I've been consistent and some things I can't discuss from a compliance standpoint. But here's gold, right? That's a nice little setup right there. Interest rates go down, gold goes up. Pretty easy correlation, folks. Just follow that. This is one of our top holdings. We've continued with gold. Treasuries, okay? Bonds are a big part of our portfolio. We also went on the long end. What does that mean, right? Well, you've got 5-year, 10-year, 20-year, okay, as an investment, 30-year. The further out, right, you're looking at a bigger risk reward. So you have an opportunity to drive that a little bit more. We added on the pullback a couple weeks ago more into the long treasuries, which has been beneficial. Outside of this, I still stick with consumer staples, but I'm getting close to dropping that. Nibbling. Sound like someone on CNBC. Buying a little bit of healthcare, more names, and then look at names that are going to do well in this type of market. Grocery stores, online, etc. Those are some individual things that I'm doing. Let's wrap this up with our game plan going forward. As always, we try and be consistent with what we're trying to communicate. Again, if you like this kind of information, we do this every couple weeks, educational videos. Subscribe, hit that like button. It will help us out. So, game plan, when will this end, right? So where are we in this particular investment cycle? Probably have seen this before, right? The new paradigm, that was when we were at the bubble, right? This was the everything bubble. Then what happens is, right, we start moving down. That was our first thrust. Denial, right? Then we have our little push back up. It's a return to normal. So we're barely hanging on to that spot right here. And that's a bull trap, right? So what happens is this return to normal sucks people in. That Robin Hoodies I talk about, the young investors and what's going on there. So that's where we are in the overall cycle. I always talk about what's your number, okay? What can you handle on the downside? Not percentage, dollars. Figure out what that is. Find opportunity, downside, upside. Like I said, we've been adding individual names to our models, okay, because there's some opportunities in certain spaces. On the downside, can't get into this here for compliance reasons, but you can hedge, you can short, cash. Cash is king right now. Have a large cash position right now. The other thing that you want to look for, the bond market. The bond market is smarter than the stock market. We are seeing that start to come down again. If that breaks, okay, that's going to be a really good signal. Volatility index, when we're above 30, 31, uninvestable. As always, follow us. The best place is Facebook because I can communicate there. Not allowed to take comments here, but that is the best place. I try and put out articles all the time. Thank you so much for watching Michael Loftus, Wealth and Wisdom TV.